Welcome to the Wealth Consulting Group's 2023 outlook for the markets. We're going to review, last year, and then I've got some experts on with me today that I'll introduce in a second. That will talk about what our outlook is for this year, and very pleased to have our Chief Investment Officer Jim Worden on our call, who leads our investment committee, and also Kristina Hooper. Well, I'll introduce a little bit more formally in a second with Invesco, who's our chief global market strategist, who's also on, and she's been a guest of our market outlooks before. So thank you very much for participating. And I'll go into their bios a little bit more in a minute. But I did want to just take a second, and on behalf of all of the advisors that are affiliated with the Wealth Consulting Group, who we support, thank all the investors and clients that are listening live to our webinar today, and are also going to listen to this and watch it in the future on a recorded session that we'll send out. So thank you very much for your business. We know that last year was a tough year for the markets. It was unprecedented in some ways in terms of not just a bear market in stocks, but we haven't seen bonds go down as much at the same time either. So for a lot of clients and balance accounts, it was not a great year. I would say that for our clients that are invested in our models that our advisors use, we had a pretty darn good year. And I'm going to ask Jim to talk about why we had a good year relative to the markets in terms of where we were over or underweighting different sectors and allocating differently to help our clients protect their capital. But we're going to spend most of the time again reviewing what happened last year and discussing this year going forward. And I'm going to try to keep this as interactive as I can. There are some presentations that both Jim and Kristina have prepared for us to look at with their presentations. But I'm going to try to keep this conversational. And we were just bantering before this recording live here about the Fed meeting that's going to be happening tomorrow, and the probability of rates going higher and what that's going to be, and when the pause was going to be. And Kristina was mentioning about what the Bank of Canada did recently. And so I'd like to continue on that type of bantering because I think it's more interesting than just reading off the slides, but there are some formal presentations that they prepared. So with that, Jim Worden has been with the Wealth Consulting Group now for about a year. And Jim is our Chief Investment Officer. He's a CFA, a CAIA, and CMT. He's got a lot of years of investment experience working with investment firms like ours, building models, monitoring models. And so we're very happy to have Jim as a part of our call. And then I've got my notes here. Kristina has a very extensive bio. Invesco as a company is a strategic partner with the Wealth Consulting Group. They're a very, very large firm with a lot of assets that they manage for institutions and for clients like you. And Kristina, in her role, leads the Global Market Strategy Office, which has strategists on the ground in North America, Europe, and Asia. Her and her team formulate the macro views of the markets and economy for Invesco. They examine the investment implications of those views and share their insights with clients and media all around the world. I'm a big fan of watching her interviews on CNBC and other news outlets. So anyway, she's awesome on TV. She's also quoted a lot in things like the Wall Street Journal, the Financial Times, the New York Times, Reuters. She has also a cum laude and a JD cum laude from Wellesley College and a JD from Pace University School of Law, on top of also being a CFP, a CAIA, like Jim has, a CIMA, and a ChFC. So we have some very smart people that are with me on the call today to talk about the markets. And again, I'm going to share the slide deck that Jim has prepared, and I'm going to put that up here now so we can talk about 2022, last year. So I'm going to ask Jim first about, what happened last year. And I think you guys could see the screen here, right, with some of Jim's notes. And Jim's going to instruct me on what slides he wants to move to. We're not going to hit all the slides that they prepared, but starting with Jim, kind of talk, Jim, about last year and what happened and why we ended up having the decline in both equity and bond markets. And then we'll switch to forecast for this year going forward. But how about last year, Jim?
Yeah, thanks, Jimmy. Great to be with you, everyone. As Jimmy mentioned, last year was a rough year. So not only was it rough for bonds, but stocks. I think the first bullet point here, I just want to highlight this because a lot of times we have these recessions, we have a bear market, and it's because corporate profits are falling and the economy is really looking bad. But this was not related to profits falling. This was related entirely due to the Fed tightening and where valuations were when the Fed tightened. So that's where we're at now. The good news is we saw all that volatility last year, but we also saw inflation peak. And so I believe that inflation has peaked in the US. And so that was the whole goal of the Federal Reserve, was to bring inflation down. So this has caused some slowing in economic growth. And there's a lot of people talking about the R word. So last year it was the I word, inflation, and this year it's the R word, recession. But I'll show some slides here in a little bit about consumers being in a very good place. Corporate balance sheets also looking good. The ongoing conflict that we've had with Russia and Ukraine that started out last March, that certainly didn't help the markets. That made things more difficult. A lot of what we get in terms of commodities, energy related areas, food commodities, these things went up a lot in price. We had a lot of volatility there, and that contributed to some of the angst that was out there last year. However, toward the end of last year, we had China reopen after a long time being closed, and that's likely going to add to some economic growth as well as smoothing out some of the supply chain issues. It might add a little bit of upward pressure on energy prices, but this is all a good thing. If you want to go next slide, Jimmy.
Yep, I'm trying to do it. There we go. Is that the one you wanted?
Yeah, that's perfect. So you can see this downtrend, right? So I'm a technician as well as a financial analyst, and you can see that most of 2020 and 2021, it was just all up and to the right. It was just smooth sailing, with the exception of that first bit with COVID, where we had that large drawdown. Well, last year it was all coming down. Now, what I think is promising is, you don't see a trend line here, but looks like we bottomed in October, and you can see on the shorter term that we're moving higher, and we've actually broken above that downward trend line. Momentum is looking better. Trends are looking better. You can go to slide 6, Jimmy, if you can.
I will. And just before we go there, I just wanted everybody to, this is obviously a slide of the S&P 500. And one of the things that we're doing in our investment committee is not only just doing fundamental research on the companies that we're invested in or the funds, but we're also looking at the trends and charts and taking that into consideration with where we think the momentum might be moving towards. And so just summarizing that, and I'll go to slide 6.
Yeah, so slide 6, this is really what a lot of people have been worried about going into this year. The bond market is completely upside down. You may hear a lot of people say it's inverted. Well, this simply just means that you can make more money buying very, very short-term debt, bonds or T-bills, than you can buying something like a 10-year treasury. So this shows the difference between a 3-month T-bill and a 10-year U.S. Treasury bond. So it's the widest we've seen prior to the last 3 recessions. It's about 1.1%. Now, this in and of itself, people would say, well, this means we will definitely have a recession. But the interesting thing is it kind of conflicts with another indicator, and that's the next slide, if you can jump one forward. So this is actually a more robust and more accurate indicator of whether we have a recession or not. This goes all the way back to the 1940s, and this is the unemployment rate. And so every single time that we've had a recession, by the way, the recession is the red line there. You see shaded, the red vertical lines. Every single time we've had a recession, we've had the unemployment rate spike a lot higher. And so this shows that we're still at multi-decade lows for unemployment. Now, there's some interesting things going on with employment. There's some people that have left the job market. They've retired early. There's some people that may be disabled, but there's about 5 million people that are not in the labor force that were in the labor force prior to COVID. Now, if they all decide to come back, then the unemployment rate is going to go up. But what this tells me is that this is not definitive that we will have a recession. It could mean that that inverted yield curve is more speaking about inflation coming down. Growth will come down with that, but we have got a very, very good job market. In some cases, depending on the industry, there's 2 job openings for every person looking for a job. So this is very good news. And then if you want to go to slide 9, Jimmy. So this is where we're at with where the Fed is at to fight inflation and the inflation measure that they use. So they use the core PCE, personal consumption's expenditure. I know it's a mouthful, but this is what they're using. That's the orange line. You can see here that this started ticking up in 2020 and 2021. It started really ticking up. And what did we hear consistently from economists as well as the Fed themselves? Inflation is transitory, which is a nice fancy word for saying it's temporary. So they said it's transitory, we don't need to worry about it. And then it got higher and higher and higher. And then come 2022, they raised rates significantly. So this is not something that they gradually did it. They raised it significantly, and they're going to do it again tomorrow, a smaller amount tomorrow. But as you can see here, the blue line finally caught up. The blue line is the Fed's raising rates. That's how high the Federal Reserve rates are. That finally caught up with the inflation rate that they're looking at. So this is very, very positive news. I think that the Fed can honestly look at this and say, hey, look, inflation is coming down. We don't need to keep raising and raising. At some point, they will pause. And with inflation continuing to come down, they can start cutting rates and they can pivot. You can go to the next slide.
Well, you know what? Before we do it,
yeah.
I wanted to ask a question, and maybe Kristina, if you could unmute, I wanted to get your input on this too. So last year, 2022, obviously the big word inflation was what caused, the Federal Bank, Reserve Bank to increase interest rates to cut down the demand from the economy, right? And so, but it was all due to inflation. And as you're showing, Jim, one measure of inflation that the Fed really looks at, the core PCE, has now come down to a level that's, where the Fed funds rates. Why is that important? And maybe Kristina, I'd like to ask you, why is that important in terms of where the Fed funds rate is versus where inflation rate is? And in your opinion, have we peaked and are we on our way down?
Has inflation peaked or the Fed funds rate peaked?
Inflation, yes.
So the conventional wisdom is that we need to raise rates in order to tamp down inflation. And that means by raising rates, we're cooling demand. And so that's how we indirectly tamp down inflation. So it may be more psychological than anything else, but seeing the Fed funds rate hit that level where it's actually higher than inflation is important. And it suggests that inflation is getting under control. In my opinion, I really do believe inflation has peaked and it's going to moderate significantly this year. So I don't think we get to the Fed's target of 2.5% 2% year-over-year inflation by the end of this year. But I do think we get to 3.8% or 3.5%. The way Jay Powell looks at inflation, and the way I presume other members of the FOMC look at inflation, is to deconstruct it and say, well, there's goods inflation, there's housing inflation, and there's services X housing. And for goods inflation, we've seen a very significant moderation there. Right. And so that is in quite good shape. It looks like it's going to continue to be in very good shape because consumers are spending on services, and also because supply chain disruptions have really eased. If you look at the New York Fed's Global Supply Chain Pressure Index, it's come down like a lead balloon. Housing inflation is clearly rolling over. Mortgage rates rose dramatically last year when the Fed started raising rates. And as a result, we're seeing housing starts slow. The industry is no longer overheating. It's calming. And then, of course, there's services X housing. That's the stubborn part, because so much of that is driven by wage growth. But I think the Fed understands that. Jim put up that slide about unemployment. It is very, very low. So that's good in terms of weathering a recession, but that does put some pressure on wage growth. Now, we are seeing signs that pressure is easing. And in fact, I would argue that we're going to continue to see an easing. It's just not going to happen as quickly as some would like, but I think it'll be enough for the Fed to hit the pause button soon.
That's great. And Jim, one of the things I've been saying a lot for the last, 6 months at least, is that the core CPI number, which is another measure of inflation, a big part of that, has been because of housing prices and how the government considers housing prices, which is called shelter. And I actually spent a lot of time on my own this year and talking to people like yourselves about how the BLS calculates that data. The government calculates that data. It's with the rearview mirror. So it's slow on the way up. There's a lag when there's housing inflation. And when it's coming back down, there's a lag too. So I think, and from what I understand, it's 40% of that core CPI number. In reality, in real time, inflation's come down a lot further than I think what we're seeing in the current data. So I've been arguing, and there's a gentleman named Dr. Jeremy Siegel, who is a pretty popular economist type person, has been around a long time. And he's been on TV talking about that for a long time. So, Jim, what do you think about inflation? Do you think that it is moderating and we're starting to see a lot better picture there? Because that's been my opinion personally on why I think the Fed might surprise us. And I think they can surprise us, even though they've been very hawkish in their statements from the different numbers of the Fed. I think they could surprise us with a pause and or even a decline maybe at the end of the year. I know a lot of people don't think that's going to happen. But what's your view on inflation, Jim?
So jump one slide prior to this one, and then I'm going to have you skip a couple after that. So everything green here, this is just looking at all those things that Kristina was mentioning, all those components that feed into inflation. Green means it's getting better. It's either going up at a slower amount or it's actually going negative. And a lot of these, it's negative. Gasoline is negative. Electricity is negative. Utility gas was negative 3.5%. You're looking at core goods down negative 0.5%. All of those in the far right are going down or they're slowing. The only thing that has been going up some still is the housing. And so I think to your point, Jimmy, there is this lag, and the chart on the right still shows that shelter is still high. But I see the data. I'm looking at a lot of other pieces. I'm sure that Kristina's looking at as well. These things are coming down. The higher interest rates making it more difficult. We saw some data come out on housing today on the Case-Shiller. That's negative. We'll likely see rents come down. If you want to jump 2 slides forward, just real quickly here. So this is that correlation between money supply growth and inflation. It's not a perfect correlation. There's a lag. And I know Kristina may have a slide similar to this, but like every time we've had this big spike in money supply growth, we've had inflation follow it. So if you go all the way back to the 70s, this happened twice. And, the growth that we had in money supply, which is the orange line, that was in the neighborhood of 10 to 12% back then. Well, during COVID, we had money supply growth that was more than 25%. So that you can see to the far right here, that orange line spiking all the way up. And what happened? We had people staying at home, collecting checks. There was multiple stimulus checks. There was unemployment going out, actually higher than normal. There was all kinds of things, lending, PPP loans, reserve requirements lower. And so now we've seen that money supply growth come down very sharply. It's actually turned negative in this chart for the first time. Inflation's moving down too, but there's just a lag. So I think between that and housing, seeing these things come down, I definitely agree that inflation is heading much lower. And to Kristina's point, wage inflation is not as bad of an issue either. And and so I think that helps the Fed look at this and hopefully say, hey, it's under control.
Yeah, I mean, if you don't mind my adding,
Sure.
I think we can all agree that inflation is moderating. I think the $64,000 question is going to be, is it moderating enough to satisfy the Fed? Because there is another set of considerations going on, I think, in the head of Jay Powell and perhaps some other FOMC members, and that is, if we don't completely extinguish inflation, will it come back? And so my great hope is that the Fed sees this, it's adequate, and they hit the pause button soon. But I think what we need to worry about is that Jay Powell is worrying about his legacy, right? And he wants to be more of a Volcker Fed chair as opposed to an Arthur Burns Fed chair. I wouldn't mind if he'd like to be an Alan Greenspan Fed chair, but that the fear is that they become so hawkish on inflation that they could hike rates even more, and we could see like a Larry Summers scenario where they take the Fed funds rate to 6% or higher. I don't think that's going to be the case, and I do think that the Bank of Canada, by hitting the pause button last week, has provided a play that the Fed can follow, in that it can decide upon a conditional pause. But to me, the big issue is going to be how the Fed views this. I think almost everyone agrees inflation is moderating. It's just a question of how much. Is it satisfactory?
Absolutely.
Yeah, that's a great point. And I think the Fed's taken a lot of heat because obviously you can see this money supply chart and how that affects inflation afterwards. And I guess that's a big fight in government and in Congress about spending and more money supply and continuing to potentially cause inflation. And a lot of critics of the Fed and Powell suggesting that this was going to be very transitory and no issue with inflation, which they were obviously very late to the game in raising rates. So I think that's part of why they, are being as mean as it sounds, in terms of how they want to raise interest rates and keep the economy from growing as fast as it has been. So, Jim, are there any other slides before we kind of switch gears that you want to share?
No, that's the last one for that section.
Okay, great. Is there anything about 2022, Kristina, that you'd like to comment on before we move on to more of an outlook for this year coming up that we're in now?
Yeah, just a couple of things that I think are important to note. So, markets don't like surprise. And what we saw last year was an overdose of surprise. In fact, I would argue the Fed surprised itself. We started 2022 with very little in the way of expectations around tightening for the year. In fact, if you look at December of 2021, when the Fed put out its dot plot with its various projections, it anticipated the Fed funds rate at the end of 2022 to be at 90 basis points, right? And then we actually get to the end of 2022 and the Fed funds rate is like 4.5% as opposed to 0.9%. So the Fed surprised itself, let alone markets. And rates went up very, very dramatically. And it wasn't just the Fed, it was a bunch of other central banks. I just want to give you a quick quote from the World Bank in September. Central banks around the world have been raising interest rates this year with a degree of synchronicity not seen over the past 5 decades. So I like to think of this as something of 2022 as an annus horribilis, to quote Queen Elizabeth, who was talking about the year when there was like a fire at Windsor Castle and Charles and Diana got divorced. But this was the market's annus horribilis, because we saw stocks go down, we saw fixed income go down. But it makes sense when you think about it in the context of monetary policy and how dramatically it went up. Surprisingly went up, and so many central banks were doing it at the same time. So that helps explain, I think, what we saw in terms of returns for 2022. But I do think it paves the way for a return to a more normal environment. Of course, we're going through a transition in 2023.
Fantastic. I'm going to share your slide and slideshow here. Hold on a second. And while I pull that up, I want to set you guys up for talking about your outlook for this year. And let's see, bear with me.
Fantastic. And actually, if you turn to slide 12.
Yep. Sorry about that.
Oh, yeah, no problem.
Oops. I apologize, everyone. It's user error here. I'm going to stop sharing and I'm going to do it again.
No worries at all. And Jim, I certainly don't want to interject now. If you wanted to share some outlook, and then I can.
No, you're good. You're good. So I think we're pretty much on the same page. I like when I look at it from a technicals. I like, one of the slides I had on there, and we don't need to show it, but like 68, almost 70% of the companies in the S&P 500 are above their 200-day moving average. And so there's some breadth. Small cap companies are performing well, and this is looking very good. The right sectors, I think, are moving higher. And so from a technical standpoint, things look good. And especially given that some of these companies in technology, we're down 50, 60, 70%, and they're coming back.
I apologize. I am trying to show the slideshow without the border here, but the way that the Zoom screen is showing up can't do that for the moment. But did you save this slide here, Kristina?
Yes, that's
and before you start, I wanted to set this up. I mean, since 1950, there's only been 2 times that we've had back-to-back negative years for the S&P 500. Once in the 70s, and once after the dot-com bubble burst in 2000. And so I think history is on the side of people that believe that this year could be a positive return for the S&P 500 and U.S. stocks. Now, another thing just happened today with the close of trading. We've had a January that now has gone up by 6%, over 6% now, I think, through today. And when Januaries have been above 5%, my good friend Ryan Dietrich over at Carson Group loves to point out that that's a very, very good sign for the remainder of the year. So I guess we've got a few things now that we can look at from a historical perspective that would potentially be in support of 2023 being a good year. So let me kind of turn it over to you, because that's what we're all hoping for, Kristina, is some good news. So tell us what you think.
So let me start at the outset by saying one other historical point to make is that the 3rd year of an election cycle has historically been a positive one. I believe the most positive one of the 4 in the cycle for equities. So just another supporting argument for why this could be a good year for stocks. I do think that we're going to see volatility earlier this year. Yes, it has been a wonderful January, but there's a very significant amount of uncertainty. And there's also around the Fed as well as, the debt ceiling, right? Which I won't call a black swan, but it's a gray rhino. A gray rhino being something you see off in the distance. It's charging towards you. It may run off in another direction, or it might come towards you. So I think there's a fair amount of uncertainty that's going to contribute to volatility earlier this year. But we have to recognize that even if we were to see a recession this year, equities tend to perform well after inflation peaks. And of course, Jim just showed you a whole host of slides that argue that inflation has peaked, and I think they're very compelling. I agree completely. And so you can see in the right-hand chart the above average peak inflation, the kind of returns we see after that. So I think that's also very encouraging as well. I just warned that early in the year, we just don't know exactly when the Fed is going to hit the pause button. I'm of the opinion that we'll see 25 basis points hiked tomorrow at the February meeting, 25 basis points at the subsequent meeting. And I think we're likely to see the Fed hit the pause button after that. And if they're smart, it will be a conditional pause like the Bank of Canada did. That means that the pause is dependent upon inflation continuing to moderate. And that kind of has some teeth in it for those who are worried that there could be some resurgence in inflation and it could become entrenched. I'm less certain about any cuts this year, just because the Fed has, is desirous of maintaining the Fed funds rate at this level. I think it would take a significant economic deterioration to prompt the Fed to cut rates before the end of the year. Now, that is certainly a distinct possibility, but I do believe my base case is that the U.S. economy avoids any kind of significant recession, that the downturn or the recession we experience, if it actually becomes a technical recession, is rather mild, because the employment situation is so good, right? One of the slides that Jim pointed to. Corporate fundamentals are in a good place, and the consumer is relatively strong. For example, let's just take one indication of that, which is what I like to call interest rate sensitivity. So if a central bank raises rates significantly, what's the impact on your average consumer? And in many countries, it can be much more problematic when a central bank hikes rates, because their mortgages are variable rate mortgages. No other country has that wonderful privilege of a 30-year fixed rate mortgage. If we look at our other Western developed countries, they don't have that. So that typically means that you can go a few years before your mortgage rate adjusts. I think, the longest you can get a fixed rate for is well less than 10 years. So there's more interest rate sensitivity, for example, for Canadians than there are for American households. So there is certainly going to be some damage on the margins. We're seeing layoffs communicated, but that's coming from industries like tech, where they have admitted, at least some of these companies have admitted that during the pandemic, they probably overhired in response to great demand for consumer tech, things like that. So I think all in all, the fundamentals are fairly good on the U.S. economy, and we're likely to avoid any kind of very significant recession. And that should be supportive of risk assets like stocks performing well, especially later in this year. So the way I think it plays out is we have volatility, and we should also have some downward pressure on equities caused by downward earnings revisions, because we know we're going to see some of those. That happens in an economic deceleration, whether or not it's actually a recession. But the countervailing force to that is going to be rates coming down, right? That actually tends to create multiple expansion. And so there's going to be something of a tug of war, and that'll contribute to volatility. But as we move through the year, what we're going to see is stocks start to anticipate, a strong economic recovery, in my opinion. And so we're likely to see good performance coming out of stocks. So,
Can I ask you something?
Yeah, please go ahead.
One of the things I've heard you talk about, which I'm very in the same opinion, is the China reopening. And Jim just
absolutely.
Earlier, I think that it's very difficult, obviously, to have a global growth story without the second, largest economy in the world participating. And China still grew last year according to their numbers, but now with their reopening and their different outlook on the COVID lockdowns that they were going through, how do you think that plays out for China as well as the world?
I think that plays out really well. I think it was underestimated what an impact the reopening would have. But 91% of the Chinese population is fully vaccinated. That compares really favorably to 68% of the UK population. So certainly there are concerns when there's a reopening in terms of the spread of COVID-19. But I think, that China has an ability to weather that much better than most other countries had when they reopened. So certainly we're going to see some impact, especially with Lunar New Year travel. But I think once we get to the second quarter, we're going to see a really robust economy in China. And we're already seeing anticipation of that in Europe. The most recent economic sentiment readings have been so much better than the month before, because there's an anticipation of what's going to happen in terms of travel, purchase of European luxury goods, all kinds of things. So that is going to be very positive for the global economy. I think we're going to start to see upward revisions to economic growth expectations for the global economy. I think the global economy avoids recession. And it should also be a positive for the U.S. economy, perhaps not as much, but certainly it should on the margins, and in a variety of different ways. For example, I think it's going to reduce even more supply chain disruptions. So that's going to help in terms of continued easing of goods prices. It will drive up commodity prices, but at the same time that we're seeing other economies start to decelerate. So it's going to compensate for that. I mean, certainly we're going to see commodity prices go higher, but all in all, I think a real positive for the global economy.
Okay. Any other slides you want to go through now, or?
Sure. If we turn to the next slide.
Okay. I have plenty of questions.
So what we're seeing is that the correction we saw last year was very much in line with past mild recessions, modest recessions. So one can make the argument that we've already had a downturn priced in last year. If you turn to the next slide, this is, to me, an argument for recovery. And some of it is actually duplicative with slides Jim showed, like M2 money supply. I do think that's a very compelling argument. But we're also seeing, of course, improvement in goods. We're seeing improvement in housing, all of which suggests inflation moderating. And that's really the key to the Fed hitting the pause button and a recovery starting to unfold by the end of this year. But again, we don't have to have an actual recovery unfolding for equities to start performing better, because they're discounting what they anticipate seeing in the future.
Hey, Jim, I want to ask you a question. I know that I mentioned earlier at the start of the presentation that we, at our firm, for our advisors and their clients, we thought we had a very good year. I mean, we were negative but we, I think, outperformed our benchmarks by a wide margin. Can you just kind of explain what some of the things that we did that would contribute to that from your view? And then I guess going in 2023, how they may look a little bit different in terms of sector changing or overweighting or underweighting?
Yeah, absolutely. So last year, as you mentioned, we did perform very well relative to our benchmarks. We were still down some, but we did much better than the benchmarks. And that was largely due to having some exposure to things like energy, overweights in energy, overweights in financials, underweights in technology and consumer discretionary, just because valuations were really, really high. Technicals were not that great. So that really contributed a lot. And also some of the positioning that we had within fixed income. For most of the year, we were underweight duration, so that helped us. And then we actually added some duration toward the end of the year. So those moves were really in anticipation for what we're going through and what we're expect to go through now. So I love the discussion Kristina had about inflation here and what we're seeing. And so this year, as we see that inflation's coming down, as we do get to the point where rates eventually will come down, and I don't know when exactly they're going to come down, but the Fed needs to pause before they cut. But that is definitely going to be beneficial for companies that are growthier types of companies that perform well in a low inflation environment. One thing that I could just add to the kind of the discussion about inflation is with China reopening, that kind of reintroduces, global trade, supply chain issues getting worked out. But globalization is good for inflation to come down. It's very deflationary. What we're seeing and hearing about technologies and I'm not sure if we're going to have an AI revolution, but there's a lot of talk about that. And so productivity gains, technological gains, those are deflationary too. And then just knowing, this is more of a slower term change, but like in 2020 or 2000, we had like roughly 70 million people that were not in the labor force. And now that's moved up to 100 million people that are not in the labor force. And so demographics is deflationary as well. When these people retire, if they're not working, they're not going to spend as much. And so I think those three forces help, but like more, they're going to help more now, like the technology and globalization, that will help bring inflation down. And so the position that we're looking at in the portfolios is really, how do we take advantage of some of the macro trends that are happening, but also looking at fundamentals and looking at technicals.
Thank you. And Kristina, before I leave your presentation, is there anything else you want me to hit before I stop sharing the presentation?
No, I think
Okay,
this
great.
is great.
So great. I think it's good now for just to have some dialogue and some questions. And so last year was the year where value stocks as a style of investing outperformed growth. Kristina, how do you think that's going to play out this year in terms of the type of companies that should do better in this environment? I think we agree with you for sure that we're going to see some volatility, especially in the first half of this year. I think that's the base case for a lot of experts out there. They think that, that's kind of common thinking at the moment, that we're going to get a lot of volatility. And then as the Fed, pauses, and as long as we don't fall into a recession in a bad way, things should start to look better. But as far as growth stocks, do you think growth stocks will ever come back in favor like they were for so many years?
Yeah, I do. I mean, typically we do see that different styles perform better in different phases or anticipating different phases of an economic cycle. Usually we will see cyclicals perform better, anticipating and being part of the recovery phase of an economic cycle. But having said that, I mean, this is a pretty compressed economic cycle. And so we're seeing rates come down, and those are helping high valuation stocks like technology. So January was a much stronger month for tech than it was for the overall stock market. So I think it'll be an interesting year where we can see cyclicals perform well, but I think tech is going to be helped. And of course, as we move through an economic cycle, we'll get to that point where the cycle matures and growth tends to perform better. So yes, I do think growth will have another day in the sun, probably sooner rather than later, and components of it could have a good day in the sun this year.
Hey, Jim, last year, I think the S&P 500, including dividends, was down over 18%. The Lehman Bond Aggregate Bond Index was down over 13%. So it was a rough year. And then we look at a lot of the big mutual funds that are out there in the industry, that are managed by, a lot of the best pros in the business that were down well over 25% in some cases. So it seemed like a lot of investors were kind of heavy in the tech sectors and the stocks that went down the most. I mean, the NASDAQ, I think, was down over 33% last year. We've had a very robust start to January. I know there are a lot of people out there. If you turn on CNBC tomorrow, going to be a lot of people that have a lot of credibility with big firms that manage a lot of money. They're going to say, look, this is a bear market rally. We're going to probably test the lows again or set new lows. I know that was common thinking just a few weeks ago. Okay. What do you think is going to happen? And then with that, I would also say, and ask maybe Kristina a follow-up question to international stocks. We talked about China, but at Invesco and Kristina, do you think that the dollar continues to come down a bit, making multinational companies, the big companies here in the U.S. that sell abroad, those companies perform better, as well as maybe international stocks, because international stocks have underperformed for so long? And so it's a two-part question, but I want to set it up with Jim first. What do you think about this rally we're in and going forward?
Yeah, so technically, you guys have, Kristina's mentioned it, January, we're off to a great start. The technical folks, the technicians that are out there are going to say there's some seasonality. This is great. But I'm looking at breadth. I'm also looking at, the companies that are coming back that were kind of, I don't want to say written off for dead, but like they had really, really rough going. So some of these that were down 50, 60, 70%. And so what's interesting is, we still call them growth companies, but their valuations contracted in some cases so much that value managers might start buying some of these growth companies. So you have that, but I think we're still in a period where quality is important. This is not a 2020, late 2020, early 2021 period where, we're shooting for the moon and like there's a lot of liquidity, a lot of speculation. I think that we can still get the growth, but it's going to be quality. It's going to be companies that are generating really good, strong cash flows, and their valuations, relative to themselves, are low. And so these, I think, will continue to grow. I like what I'm seeing in some of the technology names. I won't say it's across the board, but like we're seeing more names that are looking more attractive with good valuations that can keep going. They're at a lower base. And so, some of them are already up, 30, 40% for the year, but they were down 70% last year. And so I think we can see that continue to go. Now, a lot of this is going to come down to the Fed. Like if they come out and they're extremely hawkish and they say something like, hey, we're going to raise rates 50 basis points, and next month, they're going to raise even more, that can kind of squash that rally. But if that doesn't happen, I think there's enough inflationary data showing that inflation is really coming down significantly that the Fed may let it go, and they're not going to try to squash it. And if that's the case, then I think this rally has legs and it can keep going.
So I think before, Kristina, I turn it back to you and ask you the question about international markets. It sounds like we're on the same page, the Wealth Consulting Group Investment Committee and Invesco in your guys' analysis and your analysis of where, the markets are going to be in 2023. So I think it's a positive outlook for both of us and hopeful outlook. with that being said, we just had a portfolio review with one of our other strategic investment management firm partners, and we were discussing possibly increasing our allocation to international equities. What do you think about international stocks? You think finally there'll be an opportunity here for international stocks to shine over and above the U.S. markets?
I do think so. I mean, typically we see at the start of a new economic cycle, in that as a recovery starts to unfold, we tend to see the U.S. dollar weaken, and we tend to see small caps perform better, international perform better, and in fact, I would argue that Asia EM looks very attractive right now. They will be beneficiaries, very significant beneficiaries, in my opinion, of China's reopening, as well as Europe ex-UK. The UK has been having a tough go of it. But actually, Europe has been surprisingly resilient, given all the challenges it has faced in the last year. So I think their central bank continues to hike rates beyond what the Fed, beyond when the Fed hits the pause button. But I think Europe certainly looks attractive. It's more cyclical, and it's attractively valued.
Fantastic. Well, I think that concludes all of my formal questions that I had. I think in summary, last year was a tough year. We talked about the returns for both equities and fixed income. A little bit historic in that bonds went down as much as they did, along with the stock market going down, caused by inflation, then with the Fed raising rates. And the war didn't help out, obviously, and then we're still in the middle of that war now. In Ukraine. But with that, I think you have both suggested a very hopeful outlook for this year. Certainly, we know that the Fed's going to stop raising rates. We know that that's a certainty. Whether they decrease rates or not this year, I'm not sure if it even matters. But I think the investors are looking forward to a much more stable environment when it comes to interest rates not going up anymore, and then also possibly hopeful that interest rates could come down. And with employment being strong, and the consumer still spending and still having money, I can tell you anecdotally, just working with clients and talking to all the advisors that we work with and support. And again, I want to reiterate, thanking all the investors and clients that are going to listen and watch to this. We support your advisors. We're the back office when they're meeting with you. We're at work all the time, every single day, looking at positions and meeting with experts like Kristina and her teams that are, in control of sometimes trillions of dollars, right? So we hope to try to get as much input and advice as we can from the best out there, so that we can put that into our client accounts, on a consistent basis, those ideas. And so with that, I just wanted to thank both of you, especially Kristina, for participating, Alex, Shard, inviting Kristina, a great partner of our firm. And Jim, thank you very much. And thank you to the Wealth Consulting Group team that helped put on this webinar. So I just want to conclude. And once again, Happy New Year. I know it's a little late for that, but hopefully a great, healthy and happy year and better returns for the markets in your portfolio. So thank you, everyone, for participating and listening in.
Thank you.
Thank you.